China's massive reduction in US Treasury bond holdings has created headlines about total sellout and financial warfare. Understanding what this actually means requires separating dramatic narratives from technical market realities. China hasn't dumped all Treasury bonds overnight in panic selling. This represents strategic rebalancing over multiple years based on risk management and geopolitical considerations. The numbers reveal systematic reduction rather than emergency liquidation. China's Treasury holdings declined from over $1 trillion in 2013 to approximately $700 billion currently. This reduction occurred gradually through multiple years rather than sudden massive selling that would crash bond markets immediately. Strategic rebalancing reflects China's decision to reduce concentration risk from holding too much of any single asset class or currency. Professional portfolio management principles suggest diversification across different assets and currencies rather than excessive concentration in U.S. government debt, regardless of perceived safety. Reserve management requires balancing safety, liquidity, and return while considering geopolitical risks that could affect asset accessibility during international tensions. China's leadership concluded that massive Treasury holdings created vulnerability to sanctions or asset freezes similar to actions taken against Russia's central bank reserves. The timing shows coordination with broader Chinese policy objectives, including Belt and Road Initiative financing, domestic infrastructure investment, and international trade relationships that require capital deployment beyond passive Treasury bond ownership. China chose to deploy capital actively rather than earning low Treasury yields. Alternative investments include gold accumulation, infrastructure lending, bilateral currency agreements, and strategic commodity reserves that provide diversification while supporting Chinese economic and political objectives. These alternatives offer different risk-return profiles compared to Treasury bonds while reducing dependence on dollar-based assets. Market psychology effects from China's Treasury reduction created more immediate impact than actual supply-demand mathematics suggest. Financial media coverage amplifies concerns about foreign selling while creating perception that Treasury demand has collapsed despite continued strong demand from other sources, including domestic institutional investors. The technical reality shows that total Treasury sellout claims are exaggerated because China retains substantial holdings while reducing at measured pace rather than eliminating positions entirely. Complete exit would require coordinated selling over extended periods that would be highly visible and disruptive to global financial markets. Other foreign buyers partially offset Chinese selling, including Japan, European countries, and oil-exporting nations that maintain dollar reserves through Treasury purchases. The US Treasury market remains the world's deepest and most liquid government bond market with diverse buyer base extending beyond any single country. Bond market mechanics operate through mathematical relationships between prices and yields that automatically adjust when supply-demand conditions change. When large sellers enter markets, prices typically decline while yields increase to attract sufficient buying interest to clear available supply at market-determined prices. Interest rate increases follow automatically when bond prices fall because yields move inversely to prices through mathematical calculation rather than policy decisions. 10-year Treasury bonds purchased at higher prices show lower yields, while the same bonds trading at lower prices automatically show higher yields to new buyers. The supply-demand balance determines bond prices through auction mechanisms where buyers compete for available securities while sellers accept highest available bids. Large selling by any major holder, including China, increases supply while requiring higher yields to attract adequate buying interest from remaining market participants. Market clearing mechanisms ensure that all bonds offered for sale eventually find buyers at appropriate price levels. The question becomes what yield level attracts sufficient demand rather than whether demand exists at some price level. Higher yields automatically increase attractiveness to potential buyers, including pension funds, insurance companies, and individual investors. Treasury auctions continue attracting adequate demand despite foreign selling because domestic institutional buyers increase purchases when yields rise to attractive levels. Life insurance companies, commercial banks, and money market funds all increase Treasury allocation when yields compensate for duration risk and credit concerns. The dealer network, including primary dealers, maintains markets by purchasing treasuries when selling pressure exceeds immediate buying interest while distributing bonds to end investors over time. This market-making function provides liquidity while smoothing price impacts from large seller transactions, including foreign central bank operations. Federal Reserve policy effectiveness faces constraints when market forces overwhelm central bank guidance through fiscal pressures that require continued Treasury issuance regardless of monetary policy objectives. This condition creates fiscal dominance, where government financing needs supersede central bank interest rate preferences. Fiscal dominance occurs when government debt service costs become unsustainable at central bank target interest rates. When debt levels require continuous refinancing while deficit spending continues, markets may demand higher yields than central banks prefer for economic management purposes. The mathematical constraint emerges when debt service costs grow faster than economic output or tax revenue generation. Government spending commitments, including entitlements, defense, and interest payments, may exceed revenue while requiring continued borrowing that increases total debt burden, requiring higher yields to attract buyers. Central bank tools, including quantitative easing and forward guidance, become less effective when fiscal pressures overwhelm monetary policy transmission mechanisms. Markets focus on government financing needs rather than central bank communications when debt sustainability questions arise. Interest rate control requires coordination between fiscal and monetary authorities that becomes difficult when political priorities conflict with central bank objectives. Politicians prefer lower interest rates to reduce government borrowing costs, while central bankers may prefer higher rates to control inflation or maintain currency credibility. The disconnect between policy signals and market rates appears when Treasury yields rise despite Federal Reserve attempts to maintain lower rates through asset purchases or forward guidance. Market participants price in fiscal risks that central bank policy cannot address through traditional monetary tools. Long-term Treasury yields particularly show independence from short-term rate policy when markets question long-term fiscal sustainability. The yield curve relationship between short and long-term rates can invert or steepen beyond levels consistent with current central bank policy settings. Banking system vulnerabilities emerge through duration risk exposure, where banks hold long-term bonds purchased when interest rates were substantially lower than current market levels. Rising interest rates automatically reduce market value of existing bond portfolios while creating unrealized losses that affect bank capital ratios. Unrealized losses remain hidden in bank financial statements when bonds are classified as held-to-maturity investments that don't require mark-to-market accounting treatment. However, economic losses exist regardless of accounting classification, while creating vulnerabilities that become apparent during deposit stress or regulatory examinations. Bank capital adequacy calculations may not reflect full extent of interest rate risk when accounting rules allow held-to-maturity classification for securities that banks intend to hold until maturity. This accounting treatment prevents immediate recognition of market value declines, but doesn't eliminate underlying economic exposure. Liquidity stress reveals hidden losses when banks need to sell securities before maturity to meet deposit withdrawals or regulatory requirements. Forced sales at market prices below book values immediately realize losses that were previously unrealized, while potentially violating capital requirements or triggering regulatory intervention. Regional banks show particular vulnerability because they typically hold larger bond portfolios relative to capital compared to major money center banks. Community banks often purchased Treasury and agency securities as safe investments without fully considering interest rate risk during rising rate environments. The systemic risk emerges when multiple banks face similar unrealized losses simultaneously, while deposit competition forces higher funding costs that squeeze net interest margins. Banks cannot easily reduce bond portfolios without realizing losses while facing pressure to maintain profitability during challenging operating conditions. Commercial real estate exposure compounds banking sector risks as rising interest rates reduce property values while increasing refinancing costs for leveraged property owners. Regional banks concentrated in commercial real estate lending face potential loan losses alongside bond portfolio unrealized losses. Deposit competition increases when alternative investments, including money market funds, offer yields that exceed traditional bank deposit rates. Banks must increase deposit rates to retain customers while facing reduced net interest margins when funding costs rise faster than earning asset yields. The regulatory response possibilities include modified capital requirements, extended examination schedules, or emergency support programs designed to address systemic banking sector stress. However, regulatory intervention cannot eliminate underlying interest rate risk, while potentially creating moral hazard, encouraging excessive risk-taking. Bank consolidation pressures increase when smaller institutions lack capital or operational scale to manage interest rate risks effectively. Acquisition opportunities emerge when healthy banks purchase struggling institutions at attractive prices while assuming interest rate risk exposure. Dollar system evolution reflects gradual adjustment rather than sudden collapse, as alternative currencies and payment systems develop capabilities that reduce dependence on dollar-dominated international finance. This process occurs over years rather than months, while creating new options for international trade and reserve management. Alternative payment systems, including central bank digital currencies, bilateral swap agreements, and commodity-backed settlement mechanisms, provide options for international transactions that bypass traditional dollar clearing systems. These alternatives require years of development before achieving operational scale sufficient to challenge dollar dominance. Currency diversification by central banks shows systematic movement toward portfolio approaches that include euros, yen, gold, and other alternatives to excessive dollar concentration. This diversification occurs gradually while maintaining dollar positions because no single alternative provides equivalent liquidity and stability. International trade relationships increasingly incorporate local currency settlements that reduce transaction costs while eliminating foreign exchange risks for participating countries. China-Russia trade, India-Iran energy transactions, and regional trading arrangements all demonstrate growing alternatives to dollar-denominated commerce. The Belt and Road Initiative creates infrastructure financing arrangements that utilize Chinese yuan alongside project-specific currencies rather than requiring dollar intermediation for development projects. These arrangements establish precedents for non-dollar international financing while building Chinese influence through economic relationships. BRICS cooperation includes development of alternative financial institutions, payment systems, and reserve arrangements that provide member countries with options beyond Western-dominated institutions, including World Bank, International Monetary Fund, and SWIFT payment networks that operate primarily through dollar systems. Gold accumulation by multiple countries provides neutral reserve assets that maintain value independently from any single currency or political system. Central bank gold purchases reached record levels while providing insurance against currency devaluation or sanctions risks that affect traditional reserve assets. The commodity trading relationships increasingly utilize local currencies or barter arrangements that bypass dollar requirements while establishing direct economic relationships between producing and consuming nations. These arrangements reduce transaction costs while eliminating foreign exchange risks for participants. Regional integration initiatives, including Asian Infrastructure Investment Bank, regional development banks, and trading bloc arrangements, create alternatives to U.S.-dominated international financial architecture while providing development financing and trade facilitation independent from Western institutions. Technology development enables alternative financial systems through blockchain applications, digital currencies, and automated settlement systems that function independently from traditional correspondent banking relationships that require dollar clearing capabilities for international transactions. The transition timeline extends over decades rather than years because existing infrastructure, legal frameworks, and market relationships cannot be replaced quickly, while new systems require extensive testing and gradual adoption to achieve reliability comparable to established dollar-based systems. International cooperation challenges include coordinating multiple countries with different economic systems, political structures, and strategic objectives while building consensus around alternative arrangements that serve diverse national interests without creating new dependencies or vulnerabilities. Economic efficiency considerations suggest that integrated global financial systems provide benefits through reduced transaction costs, enhanced liquidity, and improved price discovery that fragmented regional systems cannot replicate easily. The dollar system succeeded partly because it provided genuine economic benefits rather than only reflecting American power. The network effects favor established systems because participants benefit from using same currencies and payment systems that other participants use. Alternative systems require critical mass of participants before achieving comparable benefits, while established systems maintain advantages through existing relationships and infrastructure. Historical precedent shows that reserve currency transitions typically occur over multiple decades, while involving gradual shifts rather than sudden replacements. The British pound remained important internationally for years after U.S. economic dominance was established, while the dollar gradually assumed primary reserve currency functions. Market stability depends on orderly transition processes that avoid disrupting international commerce and financial relationships that affect global economic growth and development. Sudden disruption of existing systems could create more damage than benefits, while gradual evolution allows adjustment without creating crisis conditions. Policy coordination between major economies becomes essential for managing transition processes that affect global financial stability, while ensuring that changes serve broader international interests rather than only individual country advantages. This coordination requires diplomatic relationships and economic cooperation that may conflict with other political objectives. The investment implications include portfolio diversification across different currencies, regions, and asset classes, while maintaining flexibility to adapt to changing international financial relationships. Traditional approaches based on dollar dominance may require adjustment, while new opportunities emerge from alternative systems. Risk management strategies should incorporate scenarios for continued dollar dominance, gradual transition toward multipolar currency systems, or more rapid changes triggered by crisis events that accelerate adoption of alternative arrangements. Each scenario requires different positioning while maintaining overall portfolio stability. Understanding these evolutionary processes provides context for making informed decisions, while recognizing that international financial system changes occur gradually through multiple small adjustments rather than dramatic overnight transformations that capture headlines but rarely reflect actual transition processes. The complexity of global financial relationships means that change processes involve multiple interacting factors that can develop unpredictably, while creating both opportunities and risks for investors, businesses, and policymakers who must navigate uncertainty while maintaining economic relationships essential for prosperity and stability. This analysis examines observable trends in international finance, rather than predicting specific outcomes or providing investment advice. Understanding these dynamics provides educational context while recognizing that global financial system evolution involves complex processes that require ongoing monitoring and flexible approaches rather than fixed assumptions about future developments.